For years, the crypto market was fueled by nothing but hot air and internet jokes. But look at the 2026 charts. The meme coin era is facing a brutal extinction event. While retail investors were chasing the next dog-themed token, institutional capital was quietly building a $19.3 billion floor. We are witnessing the death of speculation and the birth of the utility supercycle. A hyper-realistic transition showing a heavy, physical gold bullion bar and a modern glass skyscraper dissolving into glowing golden digital code. The code flows seamlessly into a glowing smartphone screen displaying a decentralized finance dashboard. Sleek, professional, modern tech advertising style.
Why is the market suddenly punishing projects with no real-world yield? Because the cost of capital has changed. Investors no longer want potential, they want provable. As the real-world asset market triples in a single year, the narrative has shifted. This isn't about going to the moon anymore. It's about bringing the moon's resources back to the balance sheet. Those who ignore the $19.3 billion pivot are holding bags of digital dust.
Data from Boston Consulting Group and BlackRock confirms the trend. Real-world asset, RWA, tokenization has surpassed $19.3 billion. This isn't just a number, it's a gravity well. When trillions of dollars in traditional assets, real estate, private equity, and government bonds are looking for a more efficient home, they don't look for memes, they look for infrastructure, and that infrastructure is finally ready.
Imagine a New York skyscraper. Traditionally, only the ultra-wealthy could own a piece. But through tokenization, that $500 million asset is sliced into millions of digital shards. These aren't just tokens, they are legal claims to rental income and equity, tradable in seconds. This migration of physical wealth to the blockchain is happening at record speeds because it solves the one thing traditional finance hates: illiquidity.
The most significant move isn't in real estate, it's in the most boring asset on Earth: government bonds. Tokenized T-bills have become the risk-free rate of the crypto world. By putting U.S. Treasuries on-chain, protocols are offering a 5% yield backed by the U.S. government, accessible to anyone with an internet connection. This is the bridge that traditional banking has been waiting for. Traditional markets close at 4 p.m. and take days to settle. Tokenized assets never sleep. We are moving from T+2 settlement to T0. When you can trade a fraction of a gold bar for a fraction of a warehouse at 3 a.m. on a Sunday without a middleman taking a 3% cut, the old system becomes obsolete. This efficiency is what is driving the $19.3 billion influx. Enter the protocol wars. Solana is preparing its Alpenglow upgrade, a massive overhaul designed for institutional-grade throughput. While others struggle with congestion, Alpenglow aims for sub-second finality and the ability to handle the massive transaction volume required by global payment networks. It's no longer about being fast for crypto, it's about being fast for the world.
But don't count Ethereum out. While Solana wins on speed, Ethereum is the Fort Knox of institutional trust. With BlackRock's BUIDL fund sitting on-chain, the EVM ecosystem has become the standard for regulatory compliance and security. The war between Solana's speed and Ethereum's entrenchment will determine where the next $100 billion of RWA value settles.
Behind closed doors, the titans are moving. Western Union and major global payment networks are secretly integrating stablecoin and RWA protocols. Why? Because cross-border remittances are a $600 billion market plagued by high fees. By using tokenized assets as a settlement layer, they can move money instantly for fractions of a penny. The banks aren't fighting crypto anymore, they're absorbing it.
We are exiting the era of inflationary rewards, where tokens were printed out of thin air. In the 2026 market, the only tokens that survive are those that provide real yield, value derived from actual economic activity, like property rents or bond interest. The $19.3 billion pivot is the first step toward a market where utility is the only metric that matters. The Alpenglow upgrade and the RWA explosion are not coincidences. They are the twin pillars of the new financial internet. The question isn't whether tokenization will happen, it's which protocols will capture the value of the physical world. Are you positioned for the pivot, or are you still waiting for a meme to save you? The $19.3 billion is just the beginning.
Stay ahead of the institutional curve. Subscribe for deep dives into the protocols bridging the gap between legacy finance and the future of code.